So first question for the panel here, and we'll start with Joe in the middle and have him go first. Describe for me some of the key attributes of businesses that should be looking for venture capital versus the many more businesses that probably should not look for venture capital.
That's a great question. One of the biggest problems that we have is that we see a lot of companies that are viable companies, many of which don't fit the venture capital business model. And so let me give you context on this. If you want to, do some really simple arithmetic, we're in the business of trying to make money for our LPs, and we're in a really low odds game. Statistically, only about 2 out of 10 deals do well. A few of the other 10, you might get your money back. Most of the rest, you lose most of your money. And so what it requires is that for that math to work, we have to be able to make 5 to 10 times nominally our money on the 2 winners out of 10. So every time that we're making an investment, it has to have a profile that under a great set of conditions will allow us to make 500 to 1,000% on our money. And that set of conditions typically, and these other guys may agree with some of this or they may temper it a bit, but our firm basically says, number one, for something to have that kind of an exit, it has to be a company that can achieve $100 or $200 million kind of valuation by the time we've invested 2 or 3 rounds of capital. That's the kind of total value that it has to achieve. That suggests that it has to be in a marketplace that's either already really big or getting really big, typically in the $500 million to $1 billion range in annual revenue for the total market, because what it implies is that a company can get to $50 to $100 million in revenue without having to dominate the marketplace, and then can see an exit that's in the $100 to multiple $100 million range. So for a company to really be a VC backable deal, it has to be a really big market. It typically has to be a market where there are a lot of buyers, a lot of potential exits, because 98% of the exits that we monetize are sold to strategic buyers, not to IPOs. So that's the other key thing we look at is, it may be a wonderful business, wonderful opportunity, but if there aren't a lot of potential buyers that are going to be vying for it, then it won't work for us. Because in large part of what we do is outsource product development finance. I mean, if you really want to simplify it, we're helping companies build innovative new things that can't get done within large corporations, and then if we're fortunate, a large corporation buys them.
So David, expand on that a little bit if you have other thoughts. And specifically, Joe talked about the size of the companies and the returns that he's looking for. And what about the entrepreneur who says, well, hold it, my company's only going to need $250,000, and I'm sure I can deliver to you, $3-5 million on that $250,000. That's a great IRR. Why does that still maybe not work for your fund?
Yeah, that's interesting. I've certainly heard that claim before. Well, I'd say a couple of things. One, just to add on in terms of the quality criteria, we tend to think about the same things that Joe described, but also really just this whole notion of scale. Can this be a really big business? I mean, we see a lot of great businesses that could be wonderful, but they're probably not going to be that big. And in terms of return and capital requirements, you always need more capital. I mean, I don't know that I've ever met or seen an opportunity that came in the door and told us, we need X, and that's what they really needed. They usually needed X times 2 or 3 if you were in the clean tech space for a while. So I just from that perspective, I don't think that math ultimately works out because the capital requirements often are much higher. And so, and you don't know which company is going to be the home run. You have to believe that every company is going to be the home run. But yet you don't know that they really are. So I think that's some of the thinking that goes into our process.
So Frank, do you have things you want to expand on that?
Let me just kind of take the qualitative side of it. I agree 100% with the quantitative things, but qualitatively, you have to be willing to share control of your business. You got to be willing to ask people that may or may not know your market as well as you do, their opinions on what strategies you should pursue, how you should price your product, when you can raise capital, how much money you can pay people that work inside your organization. So there are a lot of dynamics there that some entrepreneurs don't want to deal with. I was fortunate enough to grow up in an entrepreneurial family. My grandfather built a really nice chain of shoe stores, and he would always ask me, "You mean you get to tell people running the company how much they can pay themselves?" And I said, "Yeah, we actually get to opine in that." He goes, "That's bullshit." So qualitatively, you got to be willing to share control and talk about money with other people that have an interest in your company.
Great. Let's shift gears a little bit and let's talk about sectors that are interesting and hot for VCs. So, David, maybe if you can kick it off and maybe talk to the audience a bit about what do you think are some of the hottest sectors for venture investment right now?
Well, it's interesting because you always worry a little bit when you're in the hot sector because a lot of times there's the potential for a bubble to be right behind that. The spaces that we think that are really interesting and in part self-serving because of our investment thesis, some of the legacy in our co-investment with the government is one, IT security. We think that's a huge opportunity that's not going away. We've seen some cycles in that industry, as I suspect others on this panel have as well. We just recently closed an investment here in Denver in the IT security space that we're really excited about, as an example. We're also looking a lot, as others are, in digital healthcare. There's this perceived big opportunity with all the regulatory issues, the desire to shift technology base into the healthcare sector. I think we're still trying to figure out how you make money in that space, because ultimately you've got to believe a business is going to be valuable participating in that world. And then I just, personally in our firm, we also have an eye on what I'd call technology-enabled logistics. Everything from last mile fulfillment to shipping aggregation, et cetera, all around kind of the on-demand economy and the idea of just global growth.
Great. Frank, do you have sectors you want to add?
I like all those sectors. I guess from a high level, the way that I like to think about it, there are two types of market opportunities we like to pursue. One is kind of the next big thing, completely new. Boy, if it works, it's going to be big type of idea. And the other is just faster, better, cheaper. And I think IT security, which is a great market, faster, better, cheaper. You can innovate. You can do some things really well there. When digital health may be kind of a new frontier, this is a whole new market space that's materializing. So I think those are the two high-level analytic approaches that we take to it.
Yeah, I would just add that, at any given time, there are a bunch of areas that are super popular. For a while, there was this saying that if you did something that was social, local, and mobile, that was the golden triangle. And I guess what I would tell you is that we don't have a huge sector orientation. We try to look at each company that comes in and go back to is it really a big idea? Is it really a big market? Does it really look like this team can do it? And that's how we try to make our evaluation, because as a regional fund, if we were sector focused, we'd have to find the best of any individual category, and they might not be in Denver or Boulder or Fort Collins or Colorado Springs or on the East Coast. So we tend to look at each of the companies and see whether it can fit the criteria. But the things that are hot at any given time, I would just tell you, correlate very strongly to market multiples. So security is, those firms are trading at 7 to 10 times revenue when the average SaaS software company is trading at 3. So you only have to be a third as smart to make as much money if you pick the right sector like that. So that's part of the game also, is just looking at what's hot, because that's an indication of where revenues are growing fast and there's a lot of demand.
Great. So, VCs, we all like to think we're really smart and special and different. But the reality is, when it comes to industry sectors, I think VCs as a group are a lot like penguins on the edge of the ice, and they all jump in as soon as one jumps in. And so there is a herd mentality around a lot of hot sectors. And we've all seen different VC focused sectors go through boom and bust cycles. Obviously, the most famous, the dot-com, going through the dot bomb, and of course coming back in a very strong way. And other sectors that went through a boom and bust and never came back, nanotechnology probably being one of them, really has never come back as a hot VC investment area. And clean tech has certainly gone through its boom and bust, and it remains to be seen if that will ever come back as a hot VC investment area. So talk to me a bit about what you believe, Frank, why don't you kick it off, sort of drives this boom and bust cycle that we see in a lot of the hot VC segments that are out there.
Yeah, I think a tendency to not focus on the fundamentals. At the end of the day, it's not sexy, but your value proposition has to make economic sense over the long term. And if you're in markets where there are a lot of subsidies or there are a lot of artificial economic drivers that create demand, oftentimes those markets don't last. They don't persist. If you have a value proposition that is kind of long term, is kind of universal, and you pursue that value proposition doggedly, and you figure out a way to differentiate from your competition, you'll be successful.
Joe or David, anything to add to that?
I guess the only other thing I would add is that there's kind of more of a macroeconomic factor in play here, that this venture business, the early stage funding business, is terribly cyclical. It's really unfortunate, but it is really cyclical. And so it's very common that what will happen is that the public markets will start going through a bull market that will lead to a lot of M&A activity. That M&A activity will stimulate a lot more investment in early stage companies because that means there are exits. Oftentimes in conjunction with that, more money comes in from the sidelines, either from angels in directed investments or in companies that allocate more into alternative investments like venture. So you get a big influx of more money in the market. That additional money creates 2 or 3 times the number of competitors that a market can really support. It also gives those companies on average way more money than they should have. So instead of them being scrappy startups that are, highly efficient, they start doing things that are a lot less effective, and then the cycle just crashes. The public markets start slowing down, M&A starts slowing down, the venture money dries up, and all the companies that had, accomplished a $500,000 a month burn rate go out of business. So
I hear it's 4 million in the Valley right now. $500,000 yesterday, if you read the WSJ article. So David, talk to me a little bit. In these kind of events, we spend a lot of time, it seems like, talking about industry sectors like we just did. But talk to me about what's important in the companies you look at that are interesting to you other than industry sector.
Well, it's if you've ever sat in a panel like this, you probably hear the first thing is team. And it sounds a little cliche maybe, but it's actually very true. I would just suggest that the quality and caliber of the team on opportunities are just vital, because none of us can look in a crystal ball and predict all the bumps in the road. We know they'll be there, and it's the team and its ability to persevere and overcome those that will really win the day. And I think about deals that I've seen that I questioned maybe the market or the business dynamics, but the team was so persistent and determined that they made it happen in some cases. So I think that's a really important one from our perspective.
So team. We always talk about team and a great management team. Joe, help the folks in the audience understand what the heck a VC means by a great management team.
Okay, well, I'll take a somewhat negative but realistic view of this. We do really bad in this business, right? I told you, 8 out of 10 fail effectively, and the other thing that we're really bad at is knowing when we have a winner. I mean, like you said, everyone we invest in, we think will be a winner, but unfortunately, with the exception of one deal that I was lucky enough to follow Frank into, almost everything I've invested in, by the time it succeeds, is on plan B or plan C, right? So it's gotten very topical to talk about it being a pivot. But the reality of it is most of these things don't work the first time. And to me, the teams that are successful in navigating that difficult period are teams that they're people with ears, right? They're willing to take advice. They don't think they know everything. We certainly don't think we know everything, but they're willing to go get advice from people that can really help them if something isn't working. They're resilient. They are willing to keep kind of running into a brick wall until they find a way to break through. I mean, I guess I would tell you that the entrepreneurs that I have the greatest respect for are the ones that have faced that adversity of, oh my God, this isn't working, and then they are smart enough to come up with a new, well-informed alternative, and oftentimes that's what works. And so, unfortunately, sometimes you get entrepreneurs that are really smart, they really know a sector, they're really headstrong about knowing what the customer wants, knowing what the market wants, and I sometimes think those are the hardest people to work with, because again, if you're wrong 80% of the time, those are the ones that aren't going to turn fast enough and learn fast enough to be able to pivot before they run out of money and lose our confidence.
Yeah, Joe mentioned that we all fail a lot up here. So the thing that VCs and baseball players have in common is we both can get rich by being wrong most of the time. So Frank, expand on that and talk to me about the importance of experience in a management team.
Yeah, I think you look for several things. I put at the top of the list just product. You really have to, as an early stage company, figure out the product that's going to serve the market and is going to delight your customers. Once you kind of establish a toehold in the market with that initial product, you need to figure out what the strategic roadmap is that allows you to increase the share of wallet from each customer. Almost every business that we've been involved in, the entrepreneurs and the management team understand that it's easier to get your existing customers to spend more money with you than it is to get new customers. So the ability for a technology platform to exist that can be added upon and the price point can be increased is important, and a management team that understands how to execute that kind of business strategy is important as well.
So David, when you're looking at management teams, I would guess that if you've got a management team that's been there, done it, they've raised venture capital before, they've grown a successful company, they've got experience in the industry they're in, those are all really positive things, right? So as we look at tons of businesses up here, those ones tend to rise to the top. Talk to those folks out there that don't have that credit card, if you will. How should they think about, how do they navigate from where they are to getting to the point where they are in their second successful company?
Sure. Well, it's an interesting question, and some take a contrarian position and actually see that as a positive, a little bit towards Joe's point, and some folks that are so deeply entrenched in the industry, et cetera, that it might work against them as they face new markets. But we see this a lot. We've got an inspired entrepreneur who maybe either lacks just a long resume of any real operating experience or business experience, or it's in a very different market. And there's a couple things that we think about in those scenarios. One is, have they surrounded themselves with a team to bolster those gaps, is one thing. And I think that's probably pretty common sense. You would hope that somebody that's self-aware and recognizes maybe there's a deficiency or two, that they surround themselves through advisors, through other team members that complement those gaps, and they bring something forward. The second thing is, and I've seen this in the past, where maybe there's an opportunity for them to go out and participate in industry more, or in an adjacent industry that they can bring that experience to bear at a later time. And the other thing that I would suggest is just this idea that they're self-aware enough to realize that maybe we'll give them a chance, in a sense, to come and drive the company, but that ultimately they don't scale with the company. And that's maybe a little bit of a negative perspective, but I think it's actually something that really is to benefit the whole company. Some management teams just don't scale beyond certain stages of a company.
So let's shift gears a little bit, as Joe is short on time, and this is the real reverse pitch part of the session up here. The hottest companies out there that are chasing VC money will get multiple offers. They'll actually be able to choose who they would like to invest in their fund, and those are the exceptional companies, but it does really happen. So what I'd like to start, and Joe, you can kick it off since you're short on time, and Frank and David, is each of you just to spend a couple minutes pitching your firm on why should an entrepreneur, if they have the option of taking money from multiple places, why should they take your money?
Okay. That's great. I've certainly never really had to do this before, so oh my God. I'll tell you what would be important to me if I were on the other side of this. So, after having worked with lots of companies, some that worked, many that didn't, I would tell you that, for one, we have gotten really good about sticking to our knitting. We've picked out certain areas that we invest in. We only really try to invest in things where the partners have enough market knowledge and enough connective tissue in that industry to try to be able to be helpful to a company. Because if all you're doing is getting money, that is not of great value, all other things being equal. So we are pretty focused in the areas that we invest in. Part of the benefit of that is that we get a lot of pattern recognition. In many ways, part of where all of us add value on boards is by being able to tell a smart entrepreneur, we've seen this movie, and we can save you a bunch of time or a bunch of money by helping you get to the right answer on a particular development strategy or product strategy or channel strategy or whatever it is in a given segment. So, by being more focused, we get really good pattern recognition. And then I guess the other thing I would say is that our firm has a really deep operational bias. I had 20 years of real operating experience before becoming a VC. All my partners, with the exception of one, had operating experience. And what we've learned is that, like I said, most things don't work the first time. And if your investor is only financially oriented, oftentimes their solution to everything is fire the CEO or fire the head of sales, right? But if you've been in a business and you really understand operations, you've got to get deeper and get into the root cause and figure out what it really is, and then you can deal with it. So I would say that our CEOs think of us as really good, helpful business partners and coaches that aren't overbearing. That would be why you'd work with us.
Frank.
Yeah, I agree with everything Joe said. The most important thing is that the investor spends the time in the diligence process to understand your business. And I think you'll know that based upon the quality of the questions that they ask you. And if it's obvious that they just don't get it because they're asking you poor questions or irrelevant questions, listen to your gut. That's a very strong signal that it's going to be a difficult business relationship, because you're going to have to solve business problems over a large number of years, and you're going to disagree and you're going to see things a little bit differently, but you need to be comfortable that the investor has a fundamental grasp and understanding of the business that you're trying to build, or they won't be able to help you very well.
David, you have something?
Wow, you put me at the end and took all the good things. So we're all not that different. Well, here's what I would suggest, from our firm's perspective. I think a lot of the things you heard, we would also agree that we offer. And everybody on the team on our firm has either been an operator, has been a founder of multiple companies, or an early employee of multiple. So we've been on all sides of the table. We get it. That's one of the reasons we're in the business. And at the end of the day, we also know it's a relationship business. We're going to be partners over lots of years, and there will be lots of challenges on the road. And I think if you talk to companies in our portfolio, we try to be incredibly supportive of our CEOs and management teams to enable them to be successful. And I think that's an important thing, because unfortunately there is impatience at times in the marketplace, and this desire to look at other resources. And then lastly, we bring a strategic relationship with the federal government, and as well as many agencies through the legacy of some of our funds. And so we try to bring in a customer. In fact, we'll bring that customer in as part of the diligence process to somewhat help vet, but also pre-bake an opportunity for the company's products to either get non-dilutive funding or an early adopter.
Well, all of you have just experienced what happens in the VC industry, which is co-opetition. See, VCs, we cooperate a lot. We've co-invested together, but we do sometimes compete. And you noticed how nice, polite. In fact, if those were companies and I was a VC listening to those pitches, I'd say, none of you have differentiated yourselves. I'm looking for a fourth company.
On that note,
you're just
I really
all too nice. Thanks a lot, Joe. With that, I will turn it over to the audience for questions. If you can speak up loudly so I can hear you, and I will repeat the questions as well.
I have a question about, we've taken some early angel funding, and now it's a transition into institutional funding. Can you talk a little bit about, what the company needs to do to make that transition, and what you guys look for in terms of that transition?
So the question, they've raised angel capital and they're looking to make the transition into venture capital and want some insights on what venture funds look for to make that transition work the best and be the smoothest. Who would like to take it?
Well, I'll take a cut at it because I think there's a lot of different ways to look at this. There's a couple things that I would think about, and I would be thinking about this before you took the angel funding. Is one which is are these individuals professional, or are they friends and family who are going to have different perspectives potentially on what the implications to their ownership is as institutional funding comes in from venture capital, because there is typically a process where things change potentially depending on how the structure was done. I think a quality set of angels that has a relationship with the venture community is a very powerful thing, and if you've got that kind of investor in the firm, that can really facilitate and validate the opportunity. So I think from that perspective, it's good. The other aspect of it is more of a structural, which is how was the investment structured? What are the implications? Is it a clean cap table? There are a lot of those kind of dynamics that we tend to think about that are more procedural and structural. But hopefully you've got the right kind of partner that has set that pathway.
Other questions out there?
What about companies whose focus is on overseas markets?
Question is, what about companies whose focus is on overseas markets? You mean with respect to investment from venture capital funds?
Or would you invest in a company whose focus is on
Would-
South America or
Got it.
Asia?
Would your funds invest in a company that's focused on overseas markets?
There are firms that do. We don't. Now, all of our large companies that are successful ultimately sell internationally, but they start out in North America.
Well, I would just add to that a little bit. We have a portfolio company that's actually partially in China and partially in the U.S., and it's shipping aggregation for goods coming back and forth between Asia and the U.S. So that's an example where it makes a lot of sense. We've also had a company physically located outside of the U.S. That did not work out so well, and we have not done that again.
Other questions out there in the back?
What went wrong with investing overseas?
I'm sorry, what's wrong with investing overseas?
An example where one that was located outside the United States did not work out very well. What was the reason?
So I assume you're referring to what I just said a second ago. The quick story is it was a company based in the UK, and what we didn't fully grasp was the entrepreneurial dynamics felt more like banking instead of venture capital, so very risk averse, access to talent and team, and just the physical distance of being able to kind of check in and relate with the management team. We had some support on the ground with local investors, but it ultimately created a real problem, and the company would have been, we believe, wildly successful if they had been in the U.S. because of access to talent.
How does one get access
Yeah.
to a venture capitalist?
A trusted referral is the best way, and probably at the very top of that pyramid is a reference from one of our portfolio companies. If one of the CEOs that we work with calls us up and says, "Hey, I'm going to buy this product," or "I love this product," or "I love this entrepreneur," 100% guarantee you're going to get a meeting, and then it goes down the hierarchy. Usually, I meet with people that attorneys refer to me, but sometimes not. Just kidding. But attorneys and bankers, accountants that we work with. So trusted referral over the transom, over the email. Sometimes that opens the door, but not nearly as often.
Yeah, and I know I'm supposed to be moderating, but I'll add 2 cents here, which is in this day and age, with the age of social media, to go to a VC fund's website and just submit your plan, which happens a lot on our website, and they do get looked at Access, but nonetheless, versus figuring out a way to get an introduction, or if you can't do that, which would be surprising given that our business is to be connected to lots of people and we know lots of people, figure out when one of us is going to be in an event like this so you can shake our hand afterwards, then you're probably not going to be very successful as an entrepreneur. So it's kind of one of the weeding out elements.
You know, the only thing I might just add is, in the case where you maybe don't have a warm referral, you know, look at the team and figure out industry focus, deals that they've been in, and if you're aligned better with one or another, you know, do that, and at least you'll get on the radar, most likely.
Any other questions out there?
You mentioned, you had a good point about entrepreneurs being willing to give up non-economic kind of elements in the deal. That is control, monitoring information. Given the market right now, other than valuation, where do you see movement in terms of the provisions, the basis on which you make your investments? And also, just before that, could you just give us a context in terms of kind of the size of checks you guys write?
Yeah, so we write checks anywhere from 50,000 to 3 million. So broad spectrum, depending upon the stage of the business. And I guess the way I'd answer the first part of your question is it all comes down to the budget, and the budget incorporates who are we going to raise capital from, on what terms, whether it's equity or debt, who are we going to pay and how much, and what's the structure of their compensation. So as soon as you share control, and I didn't say give up, importantly, it's shared. It's always shared. It's always a partnership. But as soon as you take a large amount of somebody else's money and they have input on what your budget is going to be, that creates a very different dynamic versus you being the sole owner and the sole decision maker on what your budget's going to look like.
Well, you know, I'll just add a couple of things. You know, one, in terms of range, it's a little bit of function of how many funds we invest out of, but I'll say kind of 1 to 3, and could be a little higher or lower. We tend to not do seed stage investments unless it's something that we really believe another institutional partners is going to be involved with or going to be alongside with us down the road. In terms of control, I think it's because it's always a concern, particularly for first-time entrepreneurs. I think the thing to think about this, if you've ever looked at a term sheet and looked at the control aspects, they're all there really for only when bad things happen. They're really not there for it's got to be shared. And the last thing you want to do is get in the situation where you have to invoke some of these controls. But the other thing to think about is we have customers too, in a sense. We have LPs, investors. We have a fiduciary responsibility to wisely invest and make sure the use of their funds result in outcomes, and that's kind of part of that process.
Yeah, raising money is like marriage without the option of divorce. So it is a partnership, but it is a partnership you're going to be stuck with. And I always talk to entrepreneurs about there's explicit control and implicit control. The reality is that the way that venture deals usually are structured, there's a lot of protections. There's not a lot of explicit control that VCs have in the deal, but there's a lot of implicit, because you're going to need more capital if you're a venture-funded company, and you need to have your venture fund supportive of you in those future rounds. So you've got to understand that you have a partner and you need to work together in a cooperative way, and that's going to be a very long-term relationship.
What percentage of the company do you want to control after the first round with that 50 to 3 million?
It varies widely, but it's typically between 10 and 30%.
Yeah, I mean, it's a hard question to answer because it's really a function of value, capital requirements over the life of the deal. There are a lot of dynamics, but to short circuit it all, there's a calculus, right, that you kind of back into that says, hey, we have a return profile, and if you need dollars X over the life of the company, and we think the end game is Y, we've got to do that calculus to have enough ownership to create a return opportunity for our LPs.
So do you upfront calculate basically the eventual investment, or you only look for the initial investment?
We try to calculate it and build very fancy spreadsheets that detail everything out, and then they're never right.
Or we can just say whatever you said, and then we'll multiply that 2 or 3.
Could you guys talk about some of the ways you source deals? You mentioned referrals earlier. What are other ways that you guys find backable ventures?
Yeah, we do some PR. We do events like this. We try to make it known in the community that that we're interested in early stage technology companies that can grow into big businesses. And then we just take a lot of meetings. You know, there are only so many hours in the workday, but in the case of Access, we've got 4 local partners here, and we're just always meeting with entrepreneurs, and that network kind of perpetuates itself, and that's how we get our deal referrals.
Yeah, I mean, I'd echo a lot of that. There's a lot of legwork involved, believe it or not, and we do some outbound work as well. We've also have a team of associates that will help us on that, particularly when we're digging into very narrow industry focuses, and we really want to make sure we understand the landscape and early stage companies that are playing in it.
Other questions out there? No? All right. Well, we'll wrap up. There's one more. Just as soon as last bidder comes in.
Do you have any particular thresholds in terms of revenue, non-revenue? How long have they been in business? Customers? What are the thresholds you look for before considering companies?
So we position Access Venture Partners as a seed and early stage venture fund. And I think if you looked at the 60 companies that we've invested in, they range from pre-revenue, idea on a napkin type of thing, all the way up to, I think the largest company that we made an initial investment in was at a $10 million revenue run rate. So somewhere within that range. I would say that the typical deal, if you looked at those 60, is a company that's built a product and has a couple of customers that kind of validate that it works and that they're willing to pay for it. But we do earlier than that, and we do later than that.
Same for us. I mean, it really is a function of perception of risk. How many proof points do we need to see, which usually translates into either revenue, customers, traction of some type in that. But we're open, there is another dynamic that often happens in this industry as funds progress through their life cycle. They tend to start thinking about revenue-oriented deals, as later investments occur in terms of return profile. But overall, that's not really the primary.
I guess the other thing I'd like to add to that is it can be a long courting process, which in some instances is very good. It can be frustrating because if you're raising money, you want to raise money as fast as you can. You want to get your deal closed, and that's great. You need to think that way, but it's also good to keep prospective investors informed of your progress. And just because we pass initially doesn't mean that we pass forever. And sometimes maybe I get a little criticism for not being willing to just quickly say no. But I don't like to quickly say no. I like to identify things that I like. I like to get to know the people. I like to get to know their trajectory. I like to figure out, are we a good match? Do they like me? Do I like them? And that can take time. We've known companies for as long as 2 years before making the initial investment. So it doesn't always have to be a wham bam, thank you ma'am type of process.
Yeah, I would just we're very much like-minded. I mean, we love to spend time with the team. The team's not always excited about that because they, as you just said, want to get things done. But it is an important part of the process.
And it's a great screening question to ask VCs as you are selling to VCs and qualifying them, because the answers here would be different from other venture funds out there. Any last questions real quick here?
What are some of the things that you look for or are red flags in terms of founder teams, in terms of distribution of responsibilities, distribution of equity, how long they've been working together? What do you look for in the teams?
That's such a great question. Probably the number one thing that I put on the top of the list, and this is a nuance, but if a team is just too focused on the exit, that's a big red flag for me. Again, ultimately, we all need liquidity. That's what we're in the business of. But liquidity can come in many, many different forms. And some of the best investments that I've made, the company has been able to get liquidity in different financing events over time without selling the entire business. That's one of the neat things about private equity recapitalizations and IPOs is you can sell pieces of your position to provide liquidity without having to get all the way out of the company. So it's a long-term journey that we want to take together in building the company. And if an entrepreneur is just focused on, boy, I'm going to build this and flip it, that really turns me off. I don't like that worldview of what it's all about to build a business and build a company.
Yeah, absolutely. And there are a couple things I would add, although maybe not quite to your exact question, is any team that tells me they have no competition, I'm done.
That means no market.
And the other thing is any team that can't succinctly describe their value proposition, preferably in a quantifiable manner, or tell their story in two bullets. It's hard, but it just means you haven't thought about it enough, in my opinion, on that front.
Other questions out there? Yeah, excuse you.
I'm stealing it from you. So I work for an education-related startup that's venture-backed, for-profit, and because of the regulatory uncertainty state to state and across the country, I think that's a big question mark when a lot of people are looking at us, and I can see that extending to industries like healthcare as well. So I was wondering how you look at and quantify the regulatory uncertainty.
Well, I think you have to ask yourself whether or not the regulation is going to be persistent. One of the companies that we've invested in here locally started out when their entire value proposition was around PCI compliance. And we felt like PCI compliance was a long-term persistent regulation that was going to be a important market driver. And so we like that. That's a good thing. If you find a regulation that you think may or may not persist, less certainty around it, then that can be a bad thing. So it really comes down to how persistent do you think that regulation is going to be.
Well, the only thing I'd add are 2 points. One, I think about the regularity of the regulation in the sense from geography or regional. So is it very fragmented? Is it very locally, et cetera? That begins to be a very complex problem really quickly. The other thing is it's somewhat unique in our firm is we do spend a lot of time with federal and state agencies and government because of some of our investment thesis around the intersection of those communities. And so we tend to tap both industry and even on the government side to get some perspective on where things are heading. But at the end of the day, you don't really know because regime changes, politics, you can never 100% know.
I'm curious how heavily competition and the competitive landscape weighs on your decision to invest, and also if you have any good tips or tricks to identify competitors, since a lot of times with startups, some of the competitors might also be startups without any sort of web presence. It might be difficult to find them. You have any advice on identifying the entire competitive landscape, how important it is to you guys when you invest?
I'll say a few quick things, at least on the identification, because this is something that I think is really challenging for startups. Startups almost have to be blind to some of the realities and challenges to kind of keep the spirit of, I can do this, I can overcome. The first thing I do when I see a deal is I just do a Google search. And half the time, I pull up 6 things that a company said that they've never seen. So there's this almost bizarre where you don't want to see the competition. So my suggestion is go outside of your team and get some help with a fresh eye and lens, and I bet you're going to find a lot more. Yes, you're right. There are groups that don't appear on the radar as readily because they're in stealth mode. But I would say even today, most people are on AngelList. Most people are in social media of some form. It doesn't take a lot of work to start figuring that out.
Yeah. One of the little trite sayings I have is when you're building an early stage business plan, you need to pick an analog and you need to pick an enemy. So pick an analog, a business model that you want to emulate over time, somebody else that's been really successful that kind of gives you a roadmap into what you're building. And then pick an enemy, somebody that solves a similar problem that you're trying to solve, and differentiate yourself from that enemy.
In the back.
How crazy do you think we are when we say we're going to be this big? And do you look for people with that kind of vision that are trying to kill Google, or would you rather have us be more sane and say, okay, we're only going to be this big?
So the question was, how crazy do we think entrepreneurs are when they say they're going to be enormously big and go out and kill Google? And would we rather look at companies that are saying that, or ones that have much more modest business plans?
I think it depends on how you say it.
Delivery is important.
So, we're gonna get because and I'm just part joking, part serious. I mean, I'll just quickly say that absolutely, I applaud the level of enthusiasm and goal setting to take on a really big challenge in marketplace. I think that has to be paired with some pragmatic viewpoints, grounded in some reality, and I think if that mix is there, it absolutely can work.
Yeah, I think that's a great question. I think as long as it's a long-term vision and that the team understands the practical steps in building the product and building the competitive differentiators that have to happen to displace a large incumbent, that's a great thing. And to the extent that you can convey to an investor, and for that matter, employees and business partners, and build your culture around a big BHAG on the one hand and a focused, practical execution strategy on the other hand, boy, that's how great businesses and great value is created. So we love that.
And I just, to add a little bit to that, I don't think there's very many VCs who are interested in slow growth businesses that plan to grow slowly. So it really is about the first category, but combining, like Frank said, the near term, down to earth tactical plans. And then the key thing is getting the VCs to believe that that big vision that you have actually is possible, because that's what we're looking for. Back.
If you're looking to do a raise that involves multiple VCs, how do you go about the dynamic of combining different VCs together, like combining the different teams? Are there particular roles the different VCs take? So, for example, in a seed round, we might have a lead investor or ones that are expert in a particular space that you're in. Do those types of dynamics exist, and how do you guys typically work together when you do go into deals together as well?
We sit around the board table and argue with each other and confuse the hell out of the CEO. No, I think as you build a syndicate, you apply the same rules as you build the syndicate, whether seed, A, B, C, round capital, and that is, are these good people that understand my business? Are they well connected? Will they work hard? Can I communicate with them in order to continue to grow the business? And there's no question about the fact that one of the dynamics of any venture-backed company is you are going to have multiple voices around the table that may not always agree with each other, and it's the CEO's role to distill all that input, to distill all that advice, to keep moving forward, to take what is good advice and to disregard what is bad advice, and move forward and grow the business.
Well, absolutely, and yeah, just maybe some more details on, depending on what stage you're at. We could probably spend the next hour talking about the real dynamics that happen in syndication, formation, et cetera. But two thoughts are, one, venture firms tend to syndicate with firms that they've done deals with before. Not always, but there tends to be, or that they trust or that they know. And then there's who's driving the process. If you get in a competitive situation and you've got this dance that happens where you've got firms that you need to try to corral, and you have to take a little bit of a role in doing that. Or if you've got a trusted investor that you want to have help kind of lead and initiate the process on the syndicate formation. But it's a somewhat complex process. It depends on who's around the table.
And it also depends on how hot your company is and how great a job you've done fundraising, and if you've got multiple funds that are actually interested. Because if you've only got one that's interested, guess what? If you need money, that's where you're getting it. Any other questions out there before we wrap up? In the back?
For access, actually. Thanks. Just thinking about syndication in a different way. In a health startup myself, and thinking about not having to reinvent the wheel on the IT side, specifically security. Do you have examples or insights that you can share about how you've helped some of your invested products kind of work together?
Yeah. So quite often through the diligence process, we introduce a prospective investment to our existing portfolio, and we rely upon those folks for insight into whether or not they think it's a good idea, a good product, a good market. And oftentimes through that process, a potential partnership can materialize. And one of the nice things, and we try to do this at Access, that can happen even if the venture firm ultimately does not invest, is they do provide you with those kind of introductions. So in IT security, for example, if I ask Andy Grolnick and Chris Peterson to take a meeting, they'll take a meeting because we have that kind of relationship, and that gives you a head start on understanding whether or not Logarithm is a potential partner. It'll be up to you to convince them to do it over time, but at least we can open those doors and help facilitate those conversations for sure.
So that will wrap it up. Thank you all very much. Appreciate it.